welcome back to Dukascopy TV. I'm Natalie MacDonald, and in the studio with me today is Daniel Murray, Chief Economist from EFG Asset Management. Daniel, thank you very much for coming into the studio with us today.
Pleasure to be here, Natalie.
Now, we're going to be chatting Europe. Now, reports emerged late on Tuesday that EU Parliament is pressing for a tougher disclosure regime, which could see European banks forced to disclose their tax and profits on a country-by-country basis as the Parliament looks to make European banks stronger and safer. Is the fact that Parliament is now stepping in to fill a void created by weaker banking sort of a sign that we're moving from a bank-based to a markets-based continental European financial system, do you believe?
I think the bigger issue here really is all about tax revenue and tax collection, and the fact that several high-profile companies have been avoiding taxation or seeking to reduce their tax burden by having their revenues and profits booked in different countries. And I think that's one dimension of it. I think another dimension is that this is all part of the bank bashing that's so popular at the heart of Europe. And I think the politicians need to be a little bit careful here, because on the one hand, of course, it's sensible to have carefully run banks which are conservative, which seek to promote the flow of credit throughout the economy. But on the other hand, if you place overly burdened regulatory requirements on these banks, then it's going to diminish their ability to behave in a normal fashion. So I think they just need to be a little bit careful there about balancing the two.
Now, we saw Wall Street hit a 5-year high this week. European stocks also rallied on the back of sort of a better than expected German ZEW survey. It almost appears that last week's disastrous GDP reports have almost been forgotten, yet there are still signs that things are going to be worsening. You've got, for example, unemployment rates in Greece are expected to reach a 30.1% high. What other trouble spots do we still have? Well,
of course, roughly every 3 months we have the process via which the next tranche of aid is approved for Greece, so from the EFSF and from what will be the ESM, and also from the IMF. And that process always is associated with certain political problems. Will they, won't they? Have they satisfied the terms that the EFSF wants them to meet? So that process always creates uncertainty every few months. And we saw at the end of last year how that can be a difficult process and prone to renegotiation. I think, of course, we have the Italian elections coming up very shortly this weekend, and the German elections, of course, later this year. That noise has been relatively quiet so far, but I can see that obviously as the year progresses, that noise is going to heighten.
So if we stick with growth and GDP just for a moment, there are some that believe prosperity in Europe can come from a larger EU budget, while others believe that a bigger, freer market is the answer. Is, for example, a UK exit from the Union and sort of the subsequent reformation of this sort of provide that liberalisation in Europe, do you think?
I think that the model of European social harmony over the past 60 years has really been one of very generous state provision of social benefits, and I think that's going to have to be renegotiated across Europe. If you look at the levels of expenditure relative to GDP, they're just too high, certainly for economies where the demographics are deteriorating. So I think that's point one. In terms of the broader general economic environment and will that be improved or not by the size of the EU budget, I think it's not so much about the size of the budget, but it's about what it's used for. And at the moment, it's not clear that the EU is getting value for money in terms of the budget. And that's why certain nations recently have sought to renegotiate their budget and make it more efficient. I think that's really the key point, that policies followed and assumed by that budget need to be much more pro-growth, whereas at the moment they are really designed to maintain the status quo. I think in terms of the UK leaving the EU, this is obviously a hot topic at the moment. David Cameron recently announced that. We need to bear in mind a few points. The referendum, if it takes place, will not take place until 2017, so that's a long way away. We've got 4 years to go, and there's a lot that will happen between now and then. And over that time period, some of the polls will be pro the UK leaving the euro and some will be anti the UK leaving the euro. So markets and sentiment is going to gyrate very much dependent on the nature of those polls. I suspect in reality that if the UK were to leave the EU, there would be some pros and some cons, but life would carry on as per normal. We need to remember that predominantly the UK trades most with Europe. Europe is the UK's largest trading partner, and so it's important to maintain that relationship. I think we also need to remember that certain countries like Switzerland and Norway, although they're not part of the EU, the negotiations they've had with the EU to establish trade linkages have resulted in them having to accept, without any form of democratic representation, some of the EU laws and regulations anyway. So there's a lot of dimensions to consider there.
We've seen already Mario Draghi dismiss this week what he deems to be excessive currency war discussion. However, an appreciating euro is still a problem. How much do you believe a strong euro is harmful to a Europe rebounding?
The normal process via which countries get out of this mess is that if they have a crisis, then they usually retrench domestically, so they cut back on their fiscal expenditure, and then they offset that usually by devaluing the currency, and that then stimulates external demand. So you get this sort of balance. It's still a domestic process which is relatively painful, but the support from your external demand, from your export sector, helps to offset that. The problem in today's world is that a lot of countries are experiencing economic difficulties at the same time, and so all countries are probably inadvertently trying to devalue at the same time. And that's a natural consequence of having a looser domestic policy. With regard to the euro, that's complicated by the fact that it's a multi-nation currency area, and so not only are adjustments needed between the euro area and other countries, but adjustments are needed within the eurozone as well. My view is that on a fundamental basis, the euro is more or less fair value, and that's based on observations such as the fact that the eurozone runs more or less runs a small current account surplus. It's based on the fact that the ECB has expanded its balance sheet by less than other central banks. It's based on the fact that the eurozone has positive net foreign assets. So all these factors tend to support the currency, and say in my mind reflect the fact it's more or less at fair value. The problem is that largely reflects German economic strength. So if you take out Germany, the currencies associated with the other countries should be much weaker, and that's really the complicating factor.
Daniel, thank you so much for coming. Great comments
Natalie.
there. That's all we've got time for right now, but join us again for another exclusive interview. Goodbye for now.